So here's an example of the raw information used to determine the gain or loss on the sale of a discontinued division, as well as the profits or losses of the item that we're holding for sale, the discontinued operations. So on March 30th of a year, we decided to dispose of a component. The company, the main parent company is Rocky. The subsidiary company, or the discontinued component that they're getting rid of, is Bullwinkle. Rocky sold Bullwinkle on November 1st for $1 million, at which time the book value of the assets of the discontinued component was $2 million, and the book value of the liabilities of that discontinued component were $1.2 million. So remember, again, we're selling off a small company that in itself has assets that we can disentangle from Rocky, the ongoing portion of the company, and liabilities as well that we can separate from the ongoing portion of the company. And that is the amount that's owned by this discontinued component. During January 1st to November 1st, the Bullwinkle component had a net loss of $150,000. So again, this 150 corresponds to the revenues and the expenses of the discontinued component. So if we were just to separate out Bullwinkle and all of their revenues and expenses, then we would receive an amount of $150,000. Remember, now this is going to be a net loss, and we're going to assume that it's also a pre-tax loss. I would be better suited to really express that it's a pre-tax loss rather than a net loss, because if I just said net loss, you might assume that taxes were already removed. It says assume a 40% tax rate, and that income from continuing operations, the continuing operations being Rocky, after tax of $750,000. So we want that after tax amount. Now notice tax expense had to be taken out up here because the very first number we started with was income from continuing operations before tax. But the number I'm giving you here is this after tax amount. So we can start from income from continuing operations And it's very important that you know what you're starting with and that you read very carefully, because maybe I'll give it to you after tax. Maybe I'll give it to you before tax. And that's not just something arbitrary. You got to know when these things are taken out. You have to know what numbers you're dealing with. You know, you got to understand if someone gives you a pre-tax number, then you got to take tax out from it. But if they already give you the after-tax number, then if you remove taxes again, you're double taxing something. I mean, these are important details when you're dealing with information in a business setting. So we have $750,000 here. We don't have to remove tax expense because it was already removed. We can just go ahead and move into our discontinued operations item. So now I'll go ahead and just do it in red to sort of set it out. And you can shorthand stuff if you want to. Obviously you wouldn't if you're doing this for a client, or if you were doing this for your work as an internal accountant, or if you were turning in a formal income statement to me. I would want things to be very nicely presented, but in your work on a test or a quiz or whatever, then you can use some shorthand. So we have our discontinued operations component. We want to look for two things. First is that is this item, what were the revenues and the expenses, and aggregate those into an overall profit or loss. Well, we have a $150,000 pre-tax loss that came from this. Well, now we're going to have to determine what the after-tax amount is and what the tax effect was as well. So we have a loss from, we'll just say, discontinued operation from the disc op to, again, very shorthanded. And we don't want to disclose that 150 as the loss. We want to apply the tax rate. So we'll apply a 40% tax rate, and that gives me $60,000. Now, very careful about, it seems like a lot of times students start to misunderstand what's net of tax, what's the tax effect, what's the pre-tax amount. When I apply the tax rate, I'm getting the tax effect. So in this case, when we have a loss, we have a $60,000 tax effect. But the result or the impact of that tax effect is that actually we're paying $60,000 less in taxes because this is a loss. And so it actually reduces the after-tax loss. Taxes reduce everything. They reduce losses, they reduce profits, any amount that people are really keen on the whole idea. Oh, say if this were income. Oh, I made $150,000. If I have a 40% tax rate, then I'm going to have to deduct $60,000 and I only have $90,000 remaining. Sometimes the intuition from a loss isn't quite as clear to folks that if I have a loss, it's really a tax shield, right? I'm reducing the amount of my taxable income, and so I'm reporting less tax. So this $150,000 loss becomes a $90,000 after-tax loss. There is, of course, a shortcut because we're talking about $150,000 being the pre-tax amount. If 40% of this is taxed, right, then we have $60,000 as I calculated. Then that means the remaining amount after the taxes are taken out, the after-tax amount, is $90,000. Well, that's just 60%, right? Because we're taking a full amount, 100%, taking out 40%, only 60% is remaining. And so one way to quickly get at what the after-tax value is to take 150 and multiply it by 60% to get 90, right? It's a shortcut. If it makes sense to you, embrace it, use it. If it doesn't, then work it the longer way. That's fine too. So that $90,000 is what we would report as the after-tax loss. This is net of tax. And it helps to be complete sometimes of $60,000 because now we have the full reconstruction of the amounts. This is the after-tax. It's net of $60,000, which then means that the full amount is $150,000, right? So now we've completed that piece. Let's calculate a gain or loss on the disposal. Now remember, in the gain or the loss on disposal, we're thinking about what we got versus what we gave up. So what did I get? I got an amount of money. Right? It says it sold Bullwinkle on November 1st for $1 million. So $1 million is what I got. What did I give up? I gave up assets of $2 million. And I also gave up liabilities of $1.2 million. So when I think about what I gave up, really, I gave up some assets and I also gave up some liabilities. So when we determine what we gave up in terms of a small company, or in this case, a component that is Bullwinkle, what we gave up is really the net assets. So we really gave up $800,000 of value. And why does that make sense? Because while we gave up $2 million in assets, okay, so that would put us down $2 million. But we also gave up $1.2 million of liabilities, which actually would put us up a bit. We don't owe that money. We sold off liabilities. Someone else has to pay those liabilities now. We sold them to another company who bought Bullwinkle. We're not responsible for those anymore. So really, in net, we only gave up something of $800,000. Why? Because we gave up $2 million of resources, but that was mitigated or reduced by the fact that we also gave up $1.2 million of obligations. So what I got versus what I gave up would then be expressed as 1 million minus 800,000. I gave up 1 million. I gave up $800,000 of net assets, which means that I have a $200,000 amount. And since I got more than I gave up, this is a gain. Now, this is also still a pre-tax gain. So we're going to have to perform the same tax removal to express this after tax. And I'm just going to use the shortcut. I know that $200,000 is being split between the $80,000 tax effect at 40% and the $120,000 after-tax amount. So the after-tax amount is what I want to list on the balance on the income statement. It's a gain, so it's going to be positive, whereas we had a loss from the results of the discontinued operation. I have a gain on disposal, and it's net of tax of 80,000, which means I have 120,000 remaining. Now I combine these two, negative 90,000, right? This is a loss plus $120,000 of a gain, gets me in a $30,000 overall income increasing position. I then apply the $30,000 to my income from continuing operations after tax, and that would be $780,000. This is net income for the year that includes discontinued operations.